The stock market is reeling from the ongoing U.S. debt crisis. So let's start there. Last week, Moody's downgraded the United States' credit rating, meaning the U.S. no longer holds a perfect credit score. So there are three major credit rating agencies. Standard & Poor's downgraded the U.S. back in 2011. Fitch followed suit in 2023. And now, as of May 16th, Moody's has also downgraded the U.S. credit rating. So, Moody's issued the downgrade due to the federal government's growing national debt and persistent annual deficits. In simple terms, the government is spending more than it's earning, and the debt has reached concerning levels. Let's be honest, most people didn't pay much attention to Moody's credit downgrade. It had little immediate impact, and frankly, most folks just didn't care. But what does get people's attention is the stock market. So, we're going to shift over to that. All right, here's the reality. The U.S. government's debt crisis is only getting worse, and under President Trump this year, that trend is continuing. The government is expected to bring in about $5 trillion in revenue, but it plans to spend around $7 trillion. That means it'll need to borrow an additional $2 trillion, adding even more to the national debt. In fact, in just the first 6 months of the fiscal year, the deficit has already climbed to $1.3 trillion. Now here's the issue. The U.S. government is already set to borrow around $2 trillion this year to cover the deficit. That's the gap between what it spends and what it brings in. But that's not all. In 2025, a chunk of previously borrowed money comes due, and the government needs to repay it. The problem? It doesn't have the cash on hand. So it'll need to borrow even more just to pay off its existing debt. In 2025, about $9 trillion in existing debt is set to mature. That means, on top of the $2 trillion deficit, the government will need to borrow another $9 trillion just to roll over its old debt. That's an enormous amount of borrowing in a single year. Meanwhile, the Trump administration seems to believe that because America is the greatest, lenders will be lining up, eager to finance the government without hesitation. But that's not how things played out. The 20-year Treasury auction was a flop. To put it in relatable terms, it was a lot like Rachel Zegler and the Snow White ticket sales. Overconfidence, bad optics, and a disappointing turnout. Investors were not lining up to lend money to the U.S. government. Basically, the U.S. government had to sweeten the deal by offering higher interest rates to attract lenders. The 20-year Treasury auction ended up with the highest coupon rate since it was brought back in 2020. And to make matters worse, the interest rate on the 30-year Treasury climbed above 5%. So, here's a 5-year chart of the 30-year Treasury yield to give you some perspective. Just look at it. The trend isn't pretty. Rates are climbing steadily. So, what's behind this? It's a combination of factors. A lack of buyers, rising inflation expectations, growing concern over the U.S. deficit and debt crisis, and the broader Sell America sentiment. It's not just one issue, it's all of these together driving the trend. Now, here's the one-day chart from Wednesday. Notice how the interest rate spiked after the news broke about the poorly received auction. And here's the 10-year yield. This is the one-day chart from Wednesday. Same story, the yield spiked after news of the weak auction came out. We've talked a lot about the 10-year yield in our previous videos and emphasized how important it is, since it influences mortgage rates and impacts the stock market as well. So, here's a 3-month chart. Sitting at 4.6% is concerning. That's a high level. And I'm telling you, if this climbs to 5%, we could be facing some serious problems. So let's be clear. Higher interest rates are bad for the stock market because the market thrives on cheap and easy money. Think of it this way. If bonds are paying 0% interest, there's no real incentive to invest in them. In that case, you'd likely put your money into stocks, hoping for a better return. And when more money flows into stocks, the market goes up. But if Treasury bonds are offering 7%, 8%, 9%, even 10%, then why take the risk of investing in stocks? You could earn that return safely by lending money to the U.S. government. That shift in preference pulls money out of the stock market, which puts downward pressure on stock prices. So, bottom line, high interest rates are a real headwind for the stock market. All right? So, why are interest rates rising? Ultimately, it comes down to investors demanding higher compensation for the risks they're taking. Is 3% enough? Nope. Sapeo? Still not cutting it. Right now, the market is saying 5% is the going rate. And why? It's driven by concerns over fiscal policy, inflation, and in some cases, certain investors, institutions, or even countries choosing to distance themselves from the US. So, personally, and I don't know how you feel, but here's my take. If the government came to me and said, "Hey, John, lend us money for 30 years and we'll pay you 5% annually," my reaction would be, "Are you serious? Locking in 5% for 30 years? No way. That's just too risky, because who knows what inflation will look like over that time. In some years, inflation could shoot up to 10%, 12%, even 15%. And if I'm only earning 5% while inflation is that high, I'm actually losing money in real terms. That's a bad deal for me. So yeah, I'd want a higher interest rate to take on that kind of risk." Here's another alarming point. Take a look at this. As interest rates rise, it's going to cost the US government a lot more to borrow money. Just think about it. The government needs to borrow around $11 trillion this year, and it's doing so at much higher rates. A lot of the existing debt maturing this year carries an average interest rate of about 2.5%, but that's going to be refinanced at rates above 4%. That includes a mix of T-bills, notes, and bonds. Now look at how much the government has already spent on interest this year. It's been climbing fast. That's the result of both a growing debt load and rising interest rates. And it's only getting worse. Just look at how bad the situation has gotten. In fiscal year 2025, the government has spent more on interest payments than on Medicare, more than on national defense. In fact, interest expense is now 2.5 times greater than what we spend on veterans' benefits and services. And the troubling part is, this is only going to get worse. Now, let me show you the projections for how interest expenses are expected to grow over the next few years. But I've said it before, and I'll say it again. These numbers are off. They don't paint the full picture. Why? Because they completely ignore the possibility of future bailouts, stimulus spending, or any new reasons the government might come up with to borrow even more money. The reality is, it's likely going to be much worse than what's shown here. Now, this is just one example, but it highlights a bigger issue. Most of the estimates out there don't account for things like this. Take President Trump's tax bill, for instance. It's expected to increase the deficit. It's pretty straightforward. If the government collects less in taxes and doesn't cut spending, it will have to borrow more. That means more debt, and more debt means higher interest expenses. And just to be clear, this is coming from someone who probably dislikes taxes even more than you do. Now, I want to wrap up by making something very important clear about the stock market. So, higher interest rates are harmful to stocks. In the short term, they can trigger a market correction, or even a crash. But over the long run, due to inflation, stocks are likely to keep rising. This is what I refer to as part of the Great Melt-Up. If you haven't seen the series yet, I strongly recommend you check it out. It's for your own financial well-being and protection. Please hit that subscribe button. Thanks so much for your support. Wishing you an awesome day. Take care.